Good day. How you going? Phil Tarrant here, host of the Smart Broad Investment Show. Hope you're well. Back from Canberra after a mad week as the government handed down their budget. Treasurer Joss Frydenberg telling us how they intend to spend our money moving forward to drive forward this great nation that is Australia. Getting on my high horse, but we've done pretty well through this COVID pandemic. Economically, we're set for what I would see a good, positive time ahead for Australia. But we've got to get the finances in order. Finances are the driver of everything, not just your property portfolio, also the nation. I don't want to get too much. We're going to do a sort of full budget wrap up at a point in time once I've sort of dissected a little bit more and work out what it all means. You can get caught up in a lot of the noise and rhetoric around budgets, and a lot of it is noise. A lot of it is what ifs. We don't yet know whether or not any of these spending decisions will come to fruition if the government stays in power or not. Also spent some time down there with the Labor folk, get an understanding of how they read the tea leaves, read the play, and how they're going to go about shaping spending should they get into government come later on this year. The election be held in sometime in May, as it is right now. It still hasn't been called, so we wait with bated breath to see that was happening. A bit, just a sage reminder to me just how important the finances are with any decision making. And if I put that or look at that through the lens of property investment is a game of finance. How well you play that game, how well you administer it, how well you prepare and plan for it, how well you leverage your capabilities when it comes to your financial capability will determine how successful you are as a property investor. Now, we all know the stats, which tell us that most Australian, I think 8% of all Australians somehow claim some sort of tax benefit from the tax office as a result of being a property investor. So there's a few of us out there investing in property, and we do provide a great service, making accommodation available to all those renters out there. But the stats are that most property investors only buy one, if not two properties. And a lot of people will tell you the reason why is that they can't afford it. Well, sometimes that's the reason, but most of the reason why is because they bought the wrong property, and therefore they're hamstrung in growing and evolving that property portfolio moving forward. And the reason why they're hamstrung is that they hit a lending ceiling. That means that banks won't give them any more money to buy any more property. So they have a few choices to make. They can recalibrate the portfolio they've got. They can sell it and start again, or they can just hold the line and wait 10 years for the market to do what the market does to give them capacity to keep buying. There's a whole bunch of stuff involved in it. But the whole notion around a lending ceiling is a deep one, and it's something that you need to be right across if you want to be an effective property investor. We're going to have a chat about that today. Joining me in the studio, Matthew Lewison is the CEO, and Michael Beresford, Director Investment Services from our good friends over at OpenCorp. These are the guys that know about lending ceilings. Gentlemen, how are you going?
Hey, Phil. Well, thanks.
Good to be here.
It's always good to see you guys, and it's a highlight catching up with you guys. We do it every couple of months, and I turn to you both, and also Cameron, for getting understanding of what's going on property markets. I'm going to start there really quickly, guys. I know, Michael, you're the sort of guy who sort of gets into the numbers there at OpenCorp. Mate, what's going on with this market right now? We hear that Sydney and Melbourne is flatlining or tanking, but regional markets are still going nuts. How do you make sense of it all?
Yeah, look, I think that's probably 2 hours in itself, Bill. But look, what we do is always focus on the fundamentals, and there can be a lot of headline grabbing stories out there that talk around areas that are booming and so forth. But I think when you bring it back to the basics, which are supply, demand, and affordability, no surprise that Southeast Queensland's been a really strong market. You'd probably have to be hiding under a rock not to have heard that, given they're more than 30% up in the last 12 months. But I guess all of the different markets go through a cycle, and what we've seen in the last 12 months has been fairly abnormal from that perspective, where all of the capital cities and some of the regions have all been growing together. So, normally one market will move and it's followed by another, and so on and so forth is how the historical cycles have worked. But a little bit different in the last 12 months with all of them going up. But we think, that will normalize now with borders reopening and, different states' appetites to attract that overseas migration. We think it's definitely going to be above average levels and very strong. That's part of the government's playbook to regrow an economy after a downturn. Been happening since post World War II. So that presents a really great opportunity for ongoing demand for residential housing with the population growth, and absolutely the majority of that population growth, we feel, will be moving to the more affordable capital city locations where job creation is strong and wage growth is up.
Yeah, I think we're probably going to head into, this might be controversial, Phil. We're going to be heading into a two-speed market right now. And if you look at the speed that the vacancy rate in Sydney and Melbourne is coming down, obviously they were the lame ducks for the last year. They had good price growth, but there was huge vacancies around the CBDs. As Michael said, they're going to be the beneficiaries of a lot of the net overseas migration. We're already seeing that vacancy rate come down at an incredible pace, and vacancies are going to shrink to almost nothing. I think what we're going to see then, obviously there's already upwards pressure on rents in most capital cities, and I'm surprised you didn't get mugged in Canberra. They've got a vacancy rate of 0.5%. So the renters in Canberra must be really doing it tough, and obviously rents are going up quickly. We're going to start to see that happen in Sydney and Melbourne very shortly. But we're going to be reading in the newspapers about Sydney and Melbourne coming off the boil. And yes, there's probably going to be the median house price might be coming down. And at the top end of the market, I wouldn't be surprised if it comes down fairly swiftly. There's obviously when there's talk of interest rates going up, the executives in those blue chip suburbs might be worried about their bonuses if share prices are looking a bit shaky. But at that bottom end, that more affordable end of the market, there's just absolute scarcity of rental stock and of houses to buy, and the government's kind of thrown some oil on the fire at the affordable end of the market by increasing that home loan support scheme for first home buyers. So again, that just puts that upwards pressure at the bottom end of the market. And we've talked about this previously, the two different types of market: the pool market, where the upper end of the market drags prices up, because obviously if the top end goes up, then all of the other suburbs near them kind of look more attractive. So then they become they attract more demand. But what we really love is the bottom up market, because when you've got a bottom up market like we've got now, rents go up, there's support for prices. And when interest rates do go up a little bit, it doesn't turn it off, because people need somewhere to live. They've either got to pay for it in their rent, or they've got to push hard to get into the market as a first home buyer, and that supports those prices and pushes them up. So it's an interesting time.
It is, and the whole affordability question is something which I think is going to become completely democratized right across Australia. And yes, tick to the government to try and address this affordability, and they've said they're going to increase those places. Essentially 2% if you're a single parent, 5% deposit if you're a couple, right? So, which is good. It's going to help people get into the market quicker. But if you've got more people in that market trying to buy assets around a similar price point where investors also operate, you're just going to have massive upwards pressure. And let's say we get more property investors out of renters into owner-occupied spaces. That means there's less rental accommodation, which means the rent's going to keep going up more rapidly. But to your point, and I completely agree with you, Matt, is you're going to see this two-speed market, and it comes back to this notion of a lending ceiling in a practical sense. A mate of mine did an open home for his joint rental property. It was like a half of a duplex. He owns both of them. He had 70 genuine applications for this thing that he had to choose one punter for, right? Like, it gives you some sense for it. But I'll tell you what, that same thing isn't happening really in Docklands, all these areas out Alexandria, Docklands in Melbourne and Alexandria out there in sort of south of Sydney, where you've got huge high-rise, high-density rental accommodations, which in many ways is still a bit of a ghost town, right? Like, people aren't in there. And guess what? Property investors own most of those properties. And guess what? They're probably the property investors who only have between 1 and 2 properties. They probably bought the wrong asset at the front end. And that's like in a real practical sense. And I know I'm generalizing there, and there's pros and cons and all, and I'm happy to debate it. But that's a really simple way to look at it. The lending ceiling. Someone owns those properties, right, that don't have tenants in them right now. And people talk about the vacancy rates are really low. Yes, there is in some sides of the market, but the other side is that they're still up there, and people are struggling to get people into these places. So The lending ceiling, that's a practical way to look at it, but it's a lot deeper than that. Maybe, Matt, Michael, I'm going to hand this to you, mate. Give me a better definition of a lending ceiling rather than a Phil Tarrant definition of a lending ceiling.
Okay, so a lending ceiling is really the maximum borrowing capacity that you've got. So, if we go back to pre-GFC days, the lending criteria were pretty much as simple as a loan to value ratio and a debt servicing ratio or debt serviceability ratio. Commonly known as your LVR and your DSR. Whereas if we look at the lending environment today, then we've got a whole bunch of different kind of criteria that get applied to determine how much people can borrow and as a result, how much asset they can hold. So we've obviously got not only our actual interest rates low in terms of the repayments, but the banks are factoring in a 3% buffer interest rate on top of your actual interest rate. So that chews and eats into how much people can borrow. Then that's overlaid with the DTI, the debt to income ratio. So banks not wanting to really exceed 6 times, maybe 7 times at a stretch, the income that people have. Rent can be included in that income, but banks will shave that back. So they might take 50 to 80% of the rental income that you receive across your portfolio. They won't take 100%. So there's a lot. There are a lot more kind of restricting factors that can influence how much people can borrow and therefore where their lending ceiling sits at. So I think the point you made just before was a really pertinent one, that it's around ensuring that everything is performing for you. How can you hold as much effective asset value as possible that's actually generating an income for you? Because if you've got these assets that are either vacant, rent's not growing because you don't have the competition, you're not in the right locations where vacancy rates are really tight. Easy to say that nationally our vacancy rate is 1.6%, but there are pockets that are at 0.4% and there are pockets that are above 4%. So it can vary widely from different locations, but fundamentally it's essential to ensure that what you're holding is growing in value, is effective from a cash flow perspective with strong rental yields and tax benefits, and it's not wasting that income by requiring a lot in maintenance.
And this is very much a moment in time for markets right across Australia. It's not always like this, but you can look and there's clues there's a common thread that links all markets in Australia if you go back to the start of those markets. But Matt, maybe for you, it's very different today. Even when I look back to when I started investing, it's a lot harder to get a home loan now than what it was back then. There's a lot more oversight, a lot more bureaucratic oversight, legislative oversight on lending, and some would argue rightfully that greater rules or greater responsibility put on banks to make sure they're giving mortgages to people who can afford them. My point on that would be, well, you got to be responsible for your own thing. Someone else should be responsible for your dough. But mate, give me some sense for how these things have changed, and is this just an inflection point? Will it go back to being a little bit more elastic in how you get lending, or do you think it's only going to become more onerous?
I certainly think that it's not going to go back to the way it was before. And that's partially because of access to data. I mean, they've also got the open banking that's in place now. So banks all see everything that you've got going on. I remember when I started in the late 90s, and we could pretty much go and get our own valuation from a friendly valuer, take that to the bank and say, look, the valuation's above what we're paying. So even though we were coming up with we're only borrowing 80%. We were borrowing 80% of the valuer's value, not the contract price. So a lot of these things that they've tightened make complete sense that they've been doing it. And so I certainly don't begrudge the banks for that, but I guess it's about understanding the rules. And that was always the case. And in the past, and again, when I was starting, I think by the time I finished uni, I had an income of $30,000 a year, but I owned 6 properties. And I wouldn't have said that I was like necessarily a safe bet on those in terms of serviceability, but I was paying the bills. And obviously today you just couldn't do it. to get to that point without the income to support that. And as Michael said, it's not even just getting the income to service the loan, it's having all those buffers that they apply, and they work on an interest and principal and interest basis for your repayments, even if you're borrowing on an interest only basis. So yeah, I think these changes are here to stay. They're going to get tweaked from time to time. But again, if you know what those rules are and you can work them to your advantage to hold the best properties, then you're obviously going to do better than everyone else, or better than if you just go out and kind of throw darts at the dartboard. And a couple others that Michael didn't touch on. It's probably not as relevant for everybody, but it does play into our criteria for where we invest, and it's kind of what price points. So as you get into more expensive properties, and people kind of look at blue chip and say, oh, that's the place to be. You want to be in that. That's why they call it blue chip, like the blue chip shares. But once you get over a $3.5 million borrow on a single property, banks actually cut your LVR even further. So, and then obviously, like above it, like you might be able to borrow with lenders' mortgage insurance to 90% on affordable properties. But as that gets higher, as the property value goes up, obviously banks' propensity to lend at high LVRs diminishes. So what does that mean? It means it's, first of all, it's easier to buy an affordable property than it is to get into a more expensive one. In fact, one of the things we often look at is, could you hold two properties or three instead of just one? And you might end up owning a lot more value if you're smart about the type of property that you're buying. You also get much better rental income or rental yield on affordable properties relative to blue chip properties. And might sound great, I've got $1,500 a week rent, but when the property is worth $3 million, that's not a great yield. Versus having three properties of 500 or 600,000, you're getting $1,800 a week rent on, and obviously your cash flow is a lot better, and you're going to be better able to bridge that lender's ceiling into your next property and continue to expand your portfolio. Whereas in the past, we would have just said, never sell a property, even if it's underperforming. Often your exiting costs and then your entry costs for the next property, you go backwards. Now it's a genuine consideration if you're holding an underperforming asset, knowing that it's just really going to hold you back, not just for a year or two, it could be for the next 10 years. Mm-hmm. So yeah, it becomes a lot more, you have to be a lot more sophisticated about how you're investing now.
Yeah, and that's when you start talking about, using your money most effectively, and sometimes you've got to reshuffle the deck, right? And we'll have a bit of chat about that strategy today, but this all goes to this sort of notion of property being a game of finance, and by a game, I don't want that to sound flippant or not that important. Like, it is a game of finance, and a game being you don't cheat the system, right? The game is really the best property investors I know, and you spoke to it, Matthew, are those that know the rules and they play hard against those rules. And also the best game that you can win is something that you also set the rules in. So this is this intersection between what you can do, understanding the banks, understanding the lenders, understanding the legislation, understanding your the tax consequences and responsibilities around it. But then it takes you into how do you maneuver your way through that environment most effectively? And then you're talking about serviceability and cash flow and asset selection and all this sort of stuff. These are things that are in your control, and understanding what is out of your control, but making the decisions best in line with that. So I want to get into serviceability and how you can better beef up your borrowing capacity so you don't have lending ceilings. We'll just go to a quick break. Stay with us, back in a moment. Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show, with Michael Beresford, Director, Investment Services, and Matthew Lewison, CEO of OpenCorp. Now, serviceability, game of finance. We spoke about it before the break. How do you get more money out of your asset? Point number one. Or do you swap out assets so you can get more money out of a new one? Point number two. How do you increase serviceability without doing any of that? Point number three. Let's get stuck into it, Michael. Where do you start, mate?
Sure. So Matt spoke before the break around knowing the rules. I think that extends to knowing your portfolio as well. It's amazing on a daily basis. We're talking to people that are after this kind of guidance from us, and quite rightly, they're taking a long-term view to their property portfolio. But that doesn't mean that you can just kind of set and forget and let years pass without reviewing where things are at. So I know our property management team in the last fortnight has increased rent by over $100 a week on 4 clients' properties. And that was just from us talking around, what's the rent that you're getting? Do you know the vacancy rate's really low? Here are some comparable rentals. This is what our team's been able to achieve. Yeah, great. Can you review my rent for me? I'll bring my property across. And we've been able to increase that by $110, $120 a week. So straight away, there's a $6,000 to $6,500 pay rise that those investors have got just by reviewing their rent and working with an expert property manager on one property. So the obvious one is increasing rent. I'm amazed on a daily basis how many people, kind of treat their rental like a community service project, where it's like, my tenants are really nice, I haven't put the rent up in 10 years. You need to be smart around where you set your rent. You don't want to be pushing it, beyond the market levels and exposing yourself to vacancy. We think it's a great strategy to be just under market rents and always have a property leased. But at the same time, remember that your investments are a business, and matching that market rent and being aggressive when you can is a really wise strategy, because not every year in a full 10-year cycle you're going to be able to increase rents and increase them aggressively. So that's the first one. The first two: increasing rent, working with an expert property manager who's got their finger on the pulse with regards to what you can be charging without risking vacancy in any particular area. You mentioned tax benefits as well. That's absolutely maximizing deductions is definitely something that investors can be looking at. A lot of investors are not aware that they can be claiming depreciation deductions and significant depreciation deductions in a lot of cases, and that a depreciation schedule is required to do that. So accountants might not be asking the question around how old your property is, or was it constructed new, or was it established? These are the kind of things that people need to be looking at. And the newer the property, the more that they can claim. And that can make, depending on a marginal tax rate, that can make $3,000 to $6,000 worth of extra tax money back in your pocket just from that depreciation claim component alone, regardless of any of the other deductions that would apply. So let's say that there's a depreciation schedule that can be put in place on a new property or a relatively new property, and there's a rental increase that can happen. Could easily be another $10,000 to $12,000 of post-tax income that can be used to increase that borrowing capacity. The final one that I'd mention is just like working with an expert property manager, an expert finance broker is absolutely an essential part of your team, because we have clients bringing pre-approvals. They're generally through the big four. Those lenders, what's not well understood is that different lenders have different ways of calculating your servicing power. So just because Bank A says that your borrowing capacity is 400,000 doesn't mean that a different bank will lend you up to 750,000 based on the same circumstances. So really understanding that landscape and working with investment specialist lenders, as opposed to just going to the bank that you've always been with, reviewing your loans. And we've had, again, in the last month, we've had 8 clients where they've been going back to their bank, haven't had a borrowing capacity to be able to add to their portfolio. We've been able to achieve that borrowing capacity through lenders that are just more focused on investment lending that they weren't aware of. So there's a summary for you on some ways to increase serviceability. I'm sure Matt will have some things to add to that.
Yeah, look, I actually just want to probably add some additional detail to some of those things that you've just touched on, Michael, because what a lot of people aren't aware of either with depreciation schedules and the tax benefits of investing in property or property investments. You can actually go back and alter your previous year's tax returns if you failed to claim depreciation. So if you haven't been claiming it, there's an opportunity to do it. Again, we're happy to help people to point them in the right direction of a quantity surveyor that can prepare a depreciation schedule on the existing property. Then you can go back and claim a few years worth of tax deductions, get it as a lump sum, which can really help as well. Obviously, it's much better to do it on an ongoing basis because it improves your cash flow and you're able to keep paying your loan down. But if you've missed it, that's all right. You can catch up, not for the last 10 years, but certainly you can go back a couple of years to correct that. Just also in terms of finance broking in particular. Now, we really advocate that you need the right structure to enable your growth and to enable you to buy. And that doesn't always mean getting the cheapest interest rates. Because if a lender allows you to get into a new property and kind of their lender's ceiling might be higher than another lender's for you personally, getting into the market with your next property, starting to collect more rent and getting the ability to grow your capital base further is going to be much more beneficial than just chasing the cheapest interest rate. However, if you're at a lender's ceiling and you're a couple of years away from being able to get into your next property, then it might actually pay to go back and look at your loans and see if you can find a cheaper interest rate. And a lot of finance brokers, and this is something that people might not understand, finance broker that's getting a trailing commission on your existing loans probably isn't going to come to you and say, hey, we think you can get a cheaper interest rate. Let's have a meeting, let's catch up, let's see what we can do for you. Because if we can save you $3,000 or $4,000 a year for the next 2 years, there's an extra $8,000 you can pay off your loans. And in fact, I've had this discussion with a finance broker recently who said to me, "What if I've already got that revenue, why would I go back and do more work?" I was like, well, that's one difference, I guess, from our perspective. Our goal is to help people to grow their portfolio, not just to finance a loan for them. So we're happy for our finance brokers to do the extra work, even if it's not necessarily productive for that finance broking business. But if it helps the client pay down their loan or get a cheaper rate that will enable them to duplicate sooner, then we see that as a benefit. So again, if you've got a broker or you're dealing with a bank, just pays to probably take control of that, start to ask those questions. Or if you want somebody who's going to be able to do that for you and who's programmed, like we set it up so that we review portfolios on an annual basis. Even those that we've only just financed a year ago, we don't care if we have to do the work 2 or 3 times if it's helping the client. And that's, I think, a critical thing for people to understand as well, that they've got to make the system work for them and find people who are going to assist with that.
Yeah, around finance, I completely agree with you. If you don't have a good mortgage broker or finance broker on your team, I would really accelerate that. And the sort of case study used there, Matthew, of a broker giving that sentiment, going, I don't want to go back and do it because I've already done the work. That I think that's an anomaly. I don't hear a lot of that. I think the best mortgage brokers that I know, are constantly sitting there thinking, how can I be supporting my client or working in lockstep with a really good buyer's agent? Because right now, a lot of Australians, particularly in the capital cities, have seen a huge increase in the value of their portfolio. So they're looking to refinance, then pull out cash to go again. And this is all part of this, game of finance, right? Like, how do you best set it? I've shared, the question, like, when's the best time to review your lending options? You should always be reviewing your lending options. You should know where you're going and understanding fluctuations to how your interest rates may be moving. A lot of banks put up rates you don't even know that they're supposed to tell you. You just get sometimes a surprise shock. Interest rates are all-time low, the cash rate, but that's not stopping banks moving on interest rates. So always keep an eye out for it. And I've shared my own journey, sort of, not wanting to refinance because it's too hard versus, spending a couple of soul-destroying days on hold to banks trying to get cheaper interest rates on the current loans that I haven't. And guess what? Most banks are open for negotiation. You can sometimes push them pretty hard, and you've got to be able to sort of tolerate hours on hold. And I think back to the last time I did it, one bank in particular with a yellow logo made it very, very, very difficult for me to do that. Quick tip, and probably don't like me saying this, go to the new sales department and you'll get your phone call answered straight away, and they'll be able to put you to the right people to get repriced. So give that a red hot go. But you can completely change your borrowing capacity just by shaving some basis points off your current mortgages. And particularly if you've got a big portfolio, the thousands quickly rack up, which is a great way to present a better proposition to a bank moving forward, just secure more finance to keep going, keep evolving, keep growing your portfolio. So this is all part of this sort of cash flow component of serviceability. So if you're not yet reviewing your loans, or you haven't reviewed your loans in some time, I'd get straight onto it. And no doubt these guys over at OpenCorp can help you out, putting you in touch with the right people to make that happen. Now, there's other ways to increase your cash flow, which is sort of outside of those 4 or 5 levers that we spoke about. Let's sort of break them down. Let's go another break. Stay with us. We're back in a moment. Welcome back. Phil Tarrant from Smart Problem Investment with Matthew Lewison and Michael Beresford from OpenCorp. Now, we've spoken about the levers you can pull to increase your serviceability so you can buy more, to try and alleviate this lending ceiling, which means that you can't get no more money. Often time is a great healer of all wounds if you've bought the wrong property. Another way you can try and increase your lending ceiling is go and knock on your boss's door and ask for a pay rise. That's a really good, easy way to do it if you think that's easy. But if you're going to do that, make sure you've got a good reason why you should be getting more money. That's another way you can get going. But there's many other ways, isn't there, Michael, where you can get into a property even though you may have hit a lending ceiling. And sometimes it's just being a little bit more pragmatic and practical about it, i.e. investing with someone else is one way you can do it, isn't it?
Yeah, it's look, there are a lot of different kind of permutations in terms of how it can work. One I'll just say off the bat, we talked before around ways to increase your serviceability. One related to the tax benefit side of things that I just thought would be valuable covering off is around tax variation forms, because they're not well understood. And you made a point before around, people might want to add to their portfolio but not think that they can afford it. We see so many investors not aware of what a tax variation form is or the benefits that it provides. So in short, what it allows you to do as an investor is to take the tax benefit that you would qualify for a property or across your portfolio, and receive that tax benefit drip fed to you in each of your take-home pays during the year. So simple example, let's say that you had a property in your portfolio and it was giving you $12,000 back as annual tax benefit, and you were paid on a monthly basis. There are 2 ways that you can receive that $12,000. You can either get it as a lump sum in your tax return, which would mean that you would be contributing extra throughout the year to be able to hold the property, which is less effective for your cash flow. Or if you're paid on a monthly basis, you could get $1,000 per month extra in your take-home pay month on month through the year. Forgo the lump sum in your tax return, but by having that cash flow in your pocket, be able to hold more property without it impacting your lifestyle, and be getting a much better compound growth outcome through having that extra property in your portfolio and less strain on your cash flow. So I just wanted to mention that one because it's one that we talk to people about on a daily basis. It's not well understood.
Yeah. That's a hot tip. That's a hot tip and it's really, really smart. Essentially, rather than wait to the end of the year to put your tax return as a property investor and you get your tax back, then you just get on the way through. It's smart and not many people know about it. Speak to your accountant.
Yeah, and probably another thing to add, if you're paying down your loan balance with that extra cash flow and you're not just going off and spending it, then you're not paying interest on the amount that you've paid it down as well. So you actually get it gets a compound benefit over the life of your loan. Absolutely.
So these are the subtle little tricks and tips that, only if you've been around a bit, you actually know they're there and just assume that everyone's doing it. But Michael, I don't think many people, I know in this business, here's a lot of property investors, and I don't know how many sort of tax variation forms we're getting. So, essentially you're just keeping more of your money for longer. To Matt's point, chuck it in your offset and you're getting 3.5, maybe 4% on that. So
I think if I was to quantify it for you, Phil, I think, let's say 20 people per week I've spoken to over nearly 15 years, I reckon 5% would be aware of the tax variation form. 5% have got surplus cash flow in like a forced savings plan, and the other 90% look like you've just delivered Christmas presents in July. Yeah, they're super happy with you when you outline how that can work and how they can hold more property without it impacting their day-to-day lifestyle.
And this goes back to being a game of finance, right? Like, you're absolutely playing inside the rules. These are structural tax office legislation, right? But not many people know about it. So if you know the game and you know the rules, you can play the game a lot better. So that's really just the real case in point. But increasing cash flow and changing the way that you're investing, Michael. the point, investing with friends and family, is that a good way to get going? Should you be guaranteeing, your kids' loans to get them into property sooner, or helping to get more property? What's the sort of the quantum of all that?
Yeah, look, I think anyone that owns property or has been watching the property market, for some time, would vouch for the fact that the earlier you're in, the better the results that you achieve. So, absolutely, if there's an ability to be able to, get some parental assistance or bring forward the inheritance, as we hear, to be able to get started in the property market. Absolutely, that's a great way that parents can be helping their kids out. We see it as a big motivator for a lot of the parents that we meet with, is to be able to set up some plans to help their kids down the track get into the property market. Guarantor is another way that can be done. Slightly more restrictive. Gifting equity is by far the easiest, most flexible way to do it, and that's not just for the initial purchase, but as that buyer might look to expand their portfolio over time. That equity contribution for the deposit and costs is a little bit less restrictive than a guarantor scenario. Another one, which Matt is probably best placed to talk about because he's done it, is to buy with someone else. Matt, did you want to share about what you and Al did early days?
Yeah, I mean, there's a couple of things here too. This is a great topic as well. Could have almost been a whole nother catch up, Phil. So I bought my first property with Al. It was with my brother Alistair. It was also his first property, and we each came up with 10% plus a share of the stamp duty to get into the market. Now we ended up owning it was about 4, maybe 5 properties together over time, and we still own a couple together as well. It's at 24 years later. So for us, it was great because, first of all, it meant that when we were young, we prioritized our investment. We made sure we paid the bills, we covered the insurance, and that was done before we went and spent money, and I guess, and maybe wasted money is another way to look at it. Another thing. So when we were prioritizing that, you didn't want to let the other person down. It really helped. But it also, we knew for probably 8 years that we had exactly the same vision. We wanted to achieve the same things. We've been going to seminars. We've read every book that we could get our hands on until we were ready to invest. And there was no doubt we had a long-term view of owning property. I guess that's the challenge that we see outside of a family, is that you can start with thinking that you're on the same page because you've been chatting to your mate for a couple of years. But once you have partners, wives, kids, it can very quickly change. And again, while we've sold down some of our portfolio together to reposition into our own individual assets, every time we've done that, we've gone into it just methodically saying, which one do we want to sell? When's the right time to sell it? We're not selling under a certain price. We're not doing anything in a rush. And we would go about it that way to make sure that we weren't just trying to rob Peter to pay Paul and going backwards. One that I probably like more, if I must be honest, I mean, other than siblings, would be co-investing with your parents. It's daunting to go to your parents and saying, hey guys, can you give me some equity to go and buy my own property and give me a gift? But if you've got parents who are investors, there's a high probability they're going to want to invest again. Maybe they've hit their lending ceiling. But if you haven't started investing yet, then you might be able to work out a deal, and it's probably highly likely that they would be up for it, to say, hey, I want to co-invest with you and we can own a property 50-50. If you're young, you're in your 20s or early 30s, you've probably got a pretty good lending serviceability. If you don't already have debt, you don't have big credit card liabilities. So working out and negotiating a deal with your parents to co-invest together, I think would be a great thing. And it was great for me and my brother because it meant we were probably talking to each other multiple times a week about our property as well as other things, and working together. And yeah, I think it's a good way for parents, and I'm looking forward to being able to do that with my kids in the future as well.
Yeah, it's a good way to go about doing it, Michael. You've seen sort of benefits with that?
Yeah, I was just going to say, not often I get an opportunity to put a bit of detail on what Matt said, but I'll take this opportunity just around the borrowing in a partnership, as we call it, like with a friend or an investing mate, so to speak, just so people understand it can be a really effective way to get started. But effective investment management is about thinking about a second and third step while you're transacting on the first step. And that's the part that's not well understood with this. So while it can help, if you and I are mates, Phil, and we invest together, for example, it can help us get into the market with our first property. But the way that the lenders will look at us now is, unless we are going to continue to get each property together, if we buy one and then want to do our own thing, then the banks will only let each of us access half of the equity in the property. They'll only use half of the rental income in our servicing calculators, but we'll be responsible for all of the debt. So if something were to happen to me, you'll need to be able to cover all of the debt by yourself. So, there are a lot of buffers and restrictions, as we've talked about in this podcast already, around lending and so forth. But there are additional challenges if you're buying in a partnership, being able to get the second and third property if you're not doing it with the person that you bought the first property with.
Yeah, and that's a lot of people that for fail to realize they got to assume 100% of the debt with only 50% of the benefit. So if you've got heaps of serviceability, isn't a problem, but we're talking about lending ceilings, right? So at some point in time, everyone pretty much hits a lending season, Matt.
Yeah, I was just going to say something else we touched on really early today, which I was keen to come back to as well, was repositioning a portfolio. And it's been mentioned a few times. And while historically, I've always said, try to avoid selling a property because of all the exit costs and the entry costs with stamp duty on your next purchase. You do take a bit of a hit to do it, but there's certain times when it's absolutely essential to be able to do it. And I think, Michael, you've got a couple of examples that from the last couple of years where people have actually gone through with that, don't you?
Yeah, absolutely. So we've got a couple of clients, one that's been doing it over the last 6 months, another one that's been doing it over the last 18 months or so. They're situations where clients had multiple properties in their portfolio, 5+ properties in their portfolio. About half of the portfolio was regional, and the locations that those properties were in were appealing early days, i.e. 10 years ago and pre-kids, to these clients because the rental yields are strong, the entry point was low. While they hadn't performed significantly over the majority of the last 10 years, over the last 2 years, they have been really strong as a lot of these regional areas have been through a growth cycle. So, Don and Haley in this case have seen substantial gain, decided to sell down some of that regional portfolio, and we've been able to reposition them with basically a lower owner-occupied mortgage, more tax-effective debt, the same rental yields, but holding another $300,000 worth of asset value through that repositioning process. So that's a really good example of how we've been able to do it. A more straightforward, I guess, example is a client that has an apartment. The body corporate costs have been increasing consistently over the last 3 or 4 years. The rental growth hasn't kept pace with the increase in cost. So that investment, while the capital gain has been moderate at best, it's a real. They've got 4 kids, and it's becoming a burden in terms of cash flow. And we worked out that instead of holding a $450,000 apartment for the holding cost, then they're able to hold 2 affordable capital city properties worth about 1.1 million combined for exactly the same money out of their pocket. So with the first of those properties, we've already been able to increase the rent by $70 a week, which has now meant that they're holding nearly triple the amount of asset for less out of their pocket than what they were with that one apartment investment. So there are a couple of examples in terms of what we talk about with repositioning, and like we spoke about earlier, helping people hold as much effective asset value as possible that's generating an income for them as well.
And I think that if you just some really basic numbers, if the apartment went up 50%, and I mean, what's that, 225,000 that they'll gain, versus if the market where those other three properties, those $1.1 million worth of properties go up 50%, that's 550. So the difference between 220 odd versus 550,000 from the same market gain. And that's, as we've been talking about, just being smart with how you follow the rules, but make them work in your favor.
And this is the you got to make sure you're getting the greatest utility out of the assets that you have. And that's what we're chatting about today. And that directly impacts your ability to hold property, and therefore impacts your ability around what you can borrow. And the two key things to summarize is make sure you buy the right stuff at the front end. And then if you haven't bought the right stuff at the front end, think about how you can reshuffle that out. And Michael spoke about some examples there. So they're the sort of two key levers you need to be considering, along with some of those other sort of tactical stuff we spoke about in terms of, do you invest with other people, getting different interests, getting different rates, working with banks to try and get sharper rates, all this sort of stuff. So, Jens, that was super informative. Thanks for your time today. What's the best way? We might have confused a lot of people, Matt. Can they sort of give you guys a call and say, oh, I think I might fall into that latter camp, as in, I really like property investment, but I reckon I bought the wrong stuff. Can you help me? Or, hey, I'm starting out of this, I want to get the right stuff first. That's where you guys sit, right?
Absolutely. We've got a team of people who catch up with investors every day of the week. They love it. They're all investors themselves. We talked about, obviously, those PAYG withholding variations. I sign off on the payroll every week or every month. You'd be amazed at how low the tax rate is for the people in our business. They practice what they preach. So if you'd like to bounce things off us or get some insights, obviously our team are available to have a strategy session and talk about your situation and see if there is any opportunities for improvement in either the assets that you're holding, the tools that you're using, the finance that you have in place to enable you to be able to take those steps forward and continue to grow your portfolio.
Cool. What's the best way to book a strategy session?
So through our website, we have when there's a link that you can click. I think also just with this podcast, we'll send a link as well so that people can get there to register for the strategy session, select the time that suits them, and chat to one of our investment professionals.
Cool. All right, gentlemen, thank you. Matt Lewis and CEO, Michael Beresford, Director, Investment Services, OpenCorp. I hope you enjoyed that, everyone. Go and check that out, opencorp.com.au/strategy-session. You can go direct there. It's also in the show notes. Remember, smartpropertyinvestment.com.au if you want to keep connected with what's going on in property. That's your space or your place. Social media, Smart Property HQ. That's how I get your info. We'll see you again next time. Until then, bye-bye.